Welcome, everybody, to another episode where we dive deep into investing insights. Today, we're discussing a rather extensive text that covers years of lessons about the stock market, from S&Ls and master limited partnerships to Fannie Mae's transformation and even restaurant stocks.
Yeah, it's like an investing encyclopedia. There's a whole journey in there, from early warnings to deep dives into balance sheets, evaluating deferred earnings, and understanding cyclical stocks, right?
Absolutely. What I really found interesting is that the speaker emphasizes that behind every stock is a company with its own story. For instance, Fannie Mae is described not just as an interest rate play, but as a company that rewrote its operating model, transitioning from buying long-term mortgages at unfavorable rates to packaging them through new systems. You know, they even mention how management tightened lending standards to avoid repeating past mistakes.
That transformation was a big turning point. Right. And there's also a compelling discussion about how S&Ls, or savings and loan institutions, have different classes. The so-called Jimmy Stewart types versus the bad guys and the greedy types. The text goes on at length about how even when news headlines make S&Ls sound like property wrecking balls, the fundamentals may tell a different story.
Exactly. The text really underscores that one of the keys is to look beyond the superficial headlines and examine real metrics like the equity to assets ratio, non-performing assets, and of course the balance sheet. For instance, when a savings bank converts to public ownership, it essentially doubles its book value by returning the cash from the initial public offering to its vault. And that's a can't-lose type situation if you do your homework.
And that's such a neat idea, like when they talk about the cash in the drawer rebate from mutual savings banks. It's almost like if you borrow money from your own institution, it's like getting free money back.
Speaking of putting your money where your mouth is, the restaurant stocks and retail sectors were also heavily discussed. The narrative takes us back to the early days. Remember the story of Kentucky Fried Chicken, Dunkin' Donuts, even McDonald's? These examples show how industries that seem banal have provided explosive returns to patient investors.
Yeah, it really highlights the importance of, understanding that the fundamentals, like consistent same-store sales and margin improvements, are the real drivers. And sometimes what looks like overpricing at first can be just the market overreacting to temporary issues.
Exactly. For instance, the text describes how a stock like Pier 1 Imports became attractive after periods of underperformance, even though its earnings prospects remained solid. They talk about the 6-month checkup idea, where you reassess each holding to see if the story is still intact and if the price is still attractive relative to earnings.
Yeah, that idea of checkups, maybe similar to a doctor's appointment for your portfolio, is so important. It prevents the buy and forget syndrome that many amateur investors fall victim to.
And another recurring theme throughout the text is the idea of patience. The speaker repeatedly reminds the audience that stocks are like children. You shouldn't have more than you can manage. He even mentions that if you invest just in a handful of outstanding companies and let time work its magic, you can beat the market.
I also loved how the text throws in these Peter's principles, such as never bet on a comeback while they're playing taps, or never look back when you're driving on the Autobahn. They're almost humorous, but they really encapsulate the philosophy behind stock investing as both an art and a science.
Absolutely. The humor is subtle but effective. It's like he's saying, be present, be analytical, and trust your own understanding, because no one can predict the future. And he stresses the need to not rely solely on hindsight or on consensus opinions. For instance, when many investors sold Fannie Mae due to macro concerns, the fundamentals already indicated that home prices were actually rising.
Right, and that's a core takeaway. Don't get scared by what Wall Street experts or media pundits are saying. Instead, dig into the numbers and the company's historical performance. It's all about looking beneath the surface, like reading the balance sheet and even checking details like inventories and debt percentages.
Exactly. And it's fascinating how the discussion ties back to the notion of buying what you know. The text covers everything from the local mall, observing which stores are crowded and using that as an indicator, to understanding macro trends like the pent-up demand in the auto industry. the rule of 72, even makes an appearance as a quick heuristic for investment growth.
And also the idea that even if you miss out on a huge rally like Walmart's early years, there's always a chance to catch the next wave in an underappreciated industry.
Right. And then we have the whole section on utility stocks. There he explains that troubled utilities sometimes get punished by regulators, but eventually, once stabilized, the recovery can be dramatic. The troubled utility cycle is broken into 4 stages, from disaster to crisis management, and then stabilization and recovery. It really shows that even the most depressed stocks can bounce back if you have a long-term view.
And that ties in with his point about the even bigger picture, that in the long term, owning stocks in great companies will always outperform bonds and CDs, even if in the short term, there's plenty of volatility.
Yes, and he doesn't shy away from the reality that market declines are normal. He compares a stock market drop to a January blizzard, regular and, with the right preparation, an opportunity. It's all about being psychologically prepared and not reacting too impulsively to short-term fluctuations.
Having the stomach for it.
Now, another big topic in the text is the discussion regarding mutual funds themselves. He argues that while many fund managers can't beat the market averages, by investing in the companies that manage these funds, you might actually capture some of the gains. It's the classic sell the picks and shovels approach during a boom.
Exactly. It's a reminder that sometimes the best investment is in the infrastructure that supports the market. In this case, the mutual fund management firms, which, if run effectively, can deliver consistent returns even when the funds themselves are just averaging out.
And then there's the discussion of privatization. The text suggests that government asset sales, like telecommunications or water utilities in Britain, can be tremendous buying opportunities if you're willing to buy whatever the Queen is selling. That's a colorful way to put it.
Yeah, and it shows that geopolitics, privatization trends, and regulatory changes can create these garage sale style events where investors can get a lot of value for very little money. It's all very dynamic.
One thing I noticed is that the text is not just a set of dry rules, but rather a narrative, a diary of sorts where the investor recounts his personal experiences, missteps, and learnings. How he, for instance, got his hair cut at Supercuts, which became not just a humorous anecdote, but also an investing lesson about following quality franchises.
Right. That part had a great mix of self-deprecation and wit. It shows that even when you have to endure a personal mishap, like a regrettable haircut, you can still derive an investment insight from it. It's a reminder that investing itself is very human.
And then later, the 6-month checkup and 24-month checkup segments reinforce the idea that diligent monitoring is essential. You have to keep reassessing your holdings because the story behind each company is always evolving.
Exactly. It's like if you don't check in on a company, you might end up holding on to an asset whose fundamentals have deteriorated. It's not enough to buy a stock and assume your initial decision was perfect forever.
To sum up, the text teaches us a wealth of lessons. Understand the underlying company, know when to buy based on real performance rather than hype. Keep a lookout for undervalued bargains, even in depressed sectors such as S&Ls or troubled utilities. And, importantly, stay patient and keep doing your homework.
And even if the information can seem overwhelming, covering everything from auto cycles, restaurant trends, and global telecommunications to the nitty-gritty of S&L ratios, the core message is really about developing your own edge and not just following the herd.
Precisely. It's about cultivating that combination of art, science, and legwork, which in my mind makes investing not just a numbers game, but a lifelong journey. Whether you're analyzing a balance sheet or visiting a local mall to gauge consumer behavior, it's all part of building a successful portfolio.
Well, that's a wrap on today's discussion. The text is truly a treasure trove of insights and a reminder that investing is as much about patience, dedication, and personal experience as it is about raw numbers.
Yep, thanks for joining us. We hope you take these lessons to heart. Study your companies, don't let temporary downturns scare you off, and always keep your checkups regular. Until next time, keep investing smartly.